I'm Charlotte McLeod with the Investing News Network, and here today with me is Don Hansen. He's a private investor who has been investing in gold and silver stocks for the last 21 years. Don, thank you so much for joining me again. Great to see you.
Oh, thank you, Charlotte. I'm delighted to be here again. This is fun.
Really happy to have you back. And just to add some context for people who are out there watching, we're following up on an interview we did about a month ago at this point, where you shared some of your due diligence tactics for gold and silver stocks. So we have you back to talk about some additional research that you've done in the time since then. I think it's going to be really educational for our audience. To recap, I'm going to leave the link to the first interview in the video description, but I thought we could begin by having you go through some of the common terms that you explained to us before. So those are things like market cap, all-in sustaining costs, and gross margin. So let's begin there.
Okay, sure. The market capitalization or market cap is basically the shares outstanding for a given company times the current share price. The all-in sustaining costs is a number that's readily accessible on the corporate presentations on the websites of all the mining companies. It's very standard to provide that, and it is all the costs of production to produce gold, with the exception of G&A and corporate tax. Of course, G&A is general administrative, things like interest expense, officer salaries, legal, accounting, etc. But the all-in sustaining cost number is readily available, and going further to get a more exact profits number, it takes a lot more work, and it's not nearly as easy. And the all-in sustaining cost number gives me the gross margin, so I'll get to that one. The gross margin is basically the difference between the revenue, which is the cost of gold, the price of gold, times the amount produced, subtracted from the all-in sustaining cost times the amount produced. And so that's where you get the gross margin. So those are the terms, and those are the ones we'll be talking about when I go through the data.
Okay, thank you for going through that. I think that's going to be really helpful for everyone to understand what we're going to be talking about over the next half an hour or so. So as I was mentioning, since we had our last discussion, you've done a whole bunch more additional analysis. And one thing that you've been looking at is market cap, gross margin data in the real world. So I believe what you've done is a comparison to S&P 500's price to earnings ratio. So if you could go into that and tell us what you found there.
Okay. One of the things that I was interested in was the relationship between the market cap and the gross margin, because that's really a price earnings multiple, except I'm not going into the earnings because I would have to include G&A and corporate tax, and that's a lot more work. And besides that, what I've learned is that generally the G&A and the corporate tax consumes about half of the gross margin. And I've known that that varies, of course, according to over time. If the gross margin gets extremely large, the G&A isn't going to grow proportional with it, although the corporate tax would, of course. So the work that I did then, I looked at 12 gold miners. I changed this list a little bit from the last time, a month ago, and I deleted one that was really low, and obviously something wrong with that company. And I added Newmont, which I hadn't been in the list before, which is the world's largest gold miner. And in analyzing the market cap to gross margin for that group, the numbers varied all the way from, say, about 6 up to 12 is the ratio. Okay. And the better companies were around in the 12 number. The interesting thing is that the average of those 12 companies was about 8. And it was actually 8.3, but 8 is good enough for round numbers. I'm not looking for great precision in this. But then I said, okay, if the gross margin is about double the earnings, which is what's used in the S&P 500 when they calculate a price earnings ratio, it's the price of the shares divided by the earnings per share. And so I figured, well, then that means that the denominator will be half as much, because the gross margin, if it's 8, well, then you're going to have a number that's half of that. So that would mean that the price earnings, if that was applied to the gold miners, would be about 16, right? Okay, so then I looked up on the internet the price history for the S&P 500's price earnings ratio. And this was just dumb luck, okay? But the reality was that over the last 100 years, the average price earnings ratio for the S&P 500 was 16. The same number that I got from my calculation using the market cap to gross margin. That was just luck. The other thing I would point out, however, is that when you looked at that history of the price earnings ratio for the last 10 years, the general stock, the S&P was nowhere near 16. It was way above it. So it actually tilted the average a bit, okay, over that. I mean, it's still not an enormous amount, but it would have been, maybe it was 15 or something like that. But the other thing I thought about was, well, yeah, that's really an exceptional situation. And then I thought about that and I said, well, that shouldn't be too surprising, because during that 15-year period, we had historically low interest rates. And so what happened was that, and all the quantitative easing, all the money printing that went on, okay, so what the big corporations did was they borrowed a huge amount of money for almost nothing, less than 1% or 1%, and bought back their stock with it. And that's why the price part of price earnings ratio went through the moon. And that's what we've observed. And I also seen data that indicated that the amount of stock buyback money was about 35 or 40% of the total money that went into the stock market during that time. So the rich obviously got much richer, and that's why. But I thought that was an interesting side note of that. But it verified that my price market cap to gross margin numbers was in the right kind of ballpark. It just showed that the gold miners now are not being valued anywhere near what the other companies on the S&P are, because their price earnings is much, much higher than 16. So it tells us that if the gold miners really get hot, that number is going to get a lot larger down the road. So anyway, that's what I've heard about that.
Well, that is really interesting. And I think that will be of great interest to a lot of investors in there who are looking at the gold and silver stocks. So, we mentioned that we last spoke about a month ago, and in that space of a month, we have seen gold and silver prices really on the move. And one of the other things I know you've been looking at is how gold and silver prices, when they're higher, affect the gold and silver stocks. And I think that people might believe that they understand that on a basic level. Like, of course, if gold and silver prices go higher, stocks ideally will go higher. But you've really broken it down into percentages, very deep look at that. So we will bring up the chart that you've put together, but I wondered if you could start by just talking us through some of those numbers that you've uncovered there.
Yes, absolutely. Well, it was a few weeks ago that I was looking at the gold price and seeing that it had made a substantial move up, around 10%. And so that was on April 13th. So I said, you know what? I'm going to choose this period from February 23rd to April 12th as a period to study the relationship between the gold price and the market value of the gold miners. And so that's what I did. And so, in fact, the increase in that period for the gold price was 10.4%. And for the silver price, it was 19.4%. And that, by the way, is a relatively typical pattern, that when the gold price was up 10%, the silver up 20, and vice versa. And so I thought that was interesting in itself. And then when I looked at the various companies, I could see that the best companies were between 25 and 30% up. And there was a few laggards. But the more interesting part that occurred to me was I also looked at the price history of the GDX. which is the gold miners ETF that includes 20 or 25 gold miners, even a few silver miners. And that basically rescued me from actually doing the research on 10 or 15 more, because they had it aggregated, and that one was up 28%. So I thought, okay, what we're learning here then is that the leverage to the gold price is between 2.5 and 3, and for the better companies, it's over 3, and for the not so better, it's less. But of course, you would expect that, and so I thought that was a fascinating look at how that's working.
I think it's really interesting. And one of the other things that you brought out in your research is the difference between how much the producers move, the major producers, and then the developers and the explorers. So maybe that's a nuance that we can also look into.
Yeah. Before we do that, I wanted to mention one other thing that I did run this same issue. I noticed in my looking at the price history of gold that there was a substantial decline of the gold price in 2022. And most people might not have realized this, but we actually had a mini bear market in gold in 2022. In fact, the gold price from March to October of 2022 went down 19%, a big drop. And the price of silver went down 38%. Again, the 2 to 1. And the GDX went down 50%. Again, the 2.5 to 1 leverage. And so again, so what that told me is that the methodology that I'm using is working both in the up and the down. And so that was reassuring to me that this is looking right. Another thing that occurred to me that I should mention is I think that one of the reasons why those numbers are consistent up and down and all that is because that there's a reference point for the market. Over the last 2 years, the average gold price has been $1,800. It goes up and down, obviously, especially last year. And so that's a good reference point. I think when we would be much, much lower than 1,800 or much higher, these ratios might not make me look as smart as they do now. But they look really, really good in terms of being able to see that those relationships between the gold price and the share prices and so on is consistent both up and down in the recent past. And yeah, and then there was another piece that I looked at that was also related to this, because I really started getting into this, and I looked at the history of the gold price between April of 2022 and April of 2023. And I thought that was very curious, because it turned out that the increase in the gold price was 4.7%, but the increase in the miners was actually negative. Instead of being up like 12 or 15 by what I'd seen with the other things. So I'm thinking, in other words, these things don't always quite apply if other stuff is going on. And it's because you would have assumed that the market caps, share prices would go up 12 to 15% if the gold price went up 4.7. No, it didn't happen that way. But then I began to look at that, and I'm saying, well, wait a minute. There was something else going on here. And I wanted to bring this up to point out that people should think about this. And that is that I assume $1,200 an ounce, all the sustaining costs as of right now. Well, that made some sense because things were stable and I wasn't using a longer time frame. Okay. But if you looked at 2022, you would see that in 2021, the price of oil was around $60 an ounce, a barrel. In 2022, it was up as high as 120. And then in 2023, now it's down to 80. So what we saw is there's a lot of inflation, right? And for gold mining, the two largest cost areas are energy and labor. And so there was obviously an inflation there. so that the all-in sustaining cost wasn't $1,200 all the way along. In fact, it was probably quite a bit lower. And if you used, say, back at that time, 1,050 as an all-in sustaining cost, and then it went up to 1,200, then that would account for the difference, because then, in fact, the gross margin was shrinking, you see, because the cost was going up from 1,050 to 1,200. And so I think that's a good part of it. But the other thing is, when you see periods where there's a lot of turmoil, then the numbers start to get a little muddy. But right now we're in somewhat of a plateau, so they're easier to actually feel that your calculations make some sense. So anyway, I wanted to share that with your viewers.
Well, that's great. I think that's really interesting. And it does show, you can use your systems to figure out all these different things that you've been looking at. But when something comes up that doesn't have it make sense as you think it should, you've got to go back and figure out what other external factors there might be to look at. Really interesting.
Because you were in my calculations, I'm assuming that that was true. Another tidbit about gross margin that I should mention is that it's easy enough for any of you to calculate gross margin and see what's going on with it. For the earlier study that I did, we used $1,200 as on sustaining cost, and then I said, well, $1,800 was about the beginning in February, and then 2,000 in April. So the gross margin went from $600 to $800. Well, that's a $2,200 increase on 600. That's 33%. And if you remember earlier, what we saw was that, in fact, the gross margin went up with the share price. Or I should say the share price went up with the gross margin, because it's one that drove the other. So that was interesting too, I thought. And I didn't do it in detailed calculation of gross margins on all the companies, but I felt that that was a good enough approximation that it told me, but yes, investors actually are valuing companies based on the profits. Surprise, surprise.
Surprise, surprise. Great. And okay, and because you mentioned profits, I want to go back to that question on how we see the gold producers move in a higher gold and silver price environment versus those explorers and developers who are not producing. They are out there developing a mine, or they're exploring for metal.
Well, of course, when the gold price goes up for the producers, then their profits go up. And so you have something to compare to the change in the profits to the change in the share price, which we just talked about. Well, the explorers and developers don't have any profits. So there's nothing to relate to. So all they've got is supposedly a whole lot of metal in the ground, and there's probably some relationship to the amount and grade of the metal they've got in the ground. But it actually, over time, that does not seem to move the price of the explorers and developers very much. It much more is impacted by the quantity and grade of the drill results that tells people, well, yeah, maybe they've got a lot more than they do. But other than that, and a lot of it has to do, in terms of the explorers particularly, to do with promotion. I mean, there are some companies who spend a lot of their money basically promoting, and that's not surprising, because in the last couple of years, there's been an explosion of new explorers, because now we're in a beginning of bull market, so there's hundreds of them out there, and that's another factor. So it's very competitive. They're all competing for the investor's dollar, and for explorers, most of the investors in them, after the original founding and whatever, it comes from retail, and they have to, in order to get that, they have to promote, and so they get them named on newsletters, writers to promote them, and brokerages, and go to trade shows, and on and on and on. But so yeah, it's a very complicated issue as far as the explorers and developers. But of course, the further you get towards production and the developers, then you begin to see some more influence on the gold price, because investors can estimate, well, gee, if this company actually gets into production and its preliminary economic assessment that indicates, which is the first engineering study that they actually do to give some idea, then an investor can kind of ballpark what that profitability might be. And so that gives them some uh, indication to investors, well, this is kind of where it ought to be, kind of. But it's, again, there's so many things that have to happen before that's really a solid issue. And we can talk about some of the issues that explorers deal with. I made a list, actually, of all the things and all the questions that investors need to get answers to that they don't have to get answers to if they invest in producers. And if you want me to, I could go through that.
Yeah, I think that we should because, another concept that we talked about last time was that expected value. And as you're writing to me just recently, you've looked into that further and taken into account things that you have to consider when you are looking at these smaller companies like dilution. You don't have to think about that so much with the larger companies. So yeah, let's take a look at what you have got to say here.
Yeah, and and this is a somewhat recent revelation for me because over the years I've tended to get excited about exploration stories, as everybody does. It's the promise of big ridges and whatever. And as I'm honest with myself, I realize, I haven't made any money investing in explorers in 20 years because of all the issues that tend to come up. But I'll go through them. The first one, of course, is dilution over time. I mean, the explorers take many years to go from first drilling holes in the ground into where they actually produce gold or silver. Some of them a very long time. I invested in one in 2010 that is now starting to produce this year. I mean,
It's time.
I've lost money on that one. I actually bought into it fairly late now, just because they might actually make a few bucks when it gets into production. But this is the kind of problem. But see, they got stuck where they started just before the long bear market, and that's the problem with explorers, is that the bull markets don't last forever. And so if they don't get into production before the bull market ends, then the investing money dries up, and they're either going to go broke or they're going to have to be financed by something, usually a mountain of dilution. And so the dilution is always there because they have no revenue. And so they're going to have to keep drilling and have to keep doing engineering studies and on and on and on. And all that takes money. And again, there's a lot of competition out there for the investor dollars. So the explorers are very problematic in terms of how soon they can do what they want to do and all that. Okay, well, then there's another one, which is, and this is a very big deal that most investors don't think about at this stage, and that is we've just started a bull market in gold and silver, I believe. But we went through a long bear market. What happened during that long bear market is that all the producers laid off their geologists and mining engineers to cut costs. What do those people do? They either retired or found another way to make a living. So now all of a sudden you have all these new explorers and nobody who has experience. So a lot of these companies that are telling you these great stories, they're being told by people who've never done it before. And you have to be really, really wary of that, because a lot of those geologists, all those people, they went away because there was no work for 7 or 8 years. So what are they going to do? So that's another real challenge in terms of investing. So that in terms of that, you investor looking at the exploration picture and saying, well, okay, do you have anybody on this staff who's actually done this before in this area and looked at this kind of deposit, which is all very important and frequently very specific, needed to be in order to know they knew something. Although then the other one that always comes up is, what is the attitude of the locals where you're going to go prospectively build a mine? Sometimes the explorers go in and they don't make peace with the First Nations, if it's Canada or in other countries in South America. That's a big deal, in Chile and Peru particularly. So another issue that you want to make sure that company has actually got that handled. Otherwise, they spend too much money and it's worthless. Oh, let's see. Oh, and another one. Infrastructure availability. Are there roads to the place? Is there power? Is there water? I mean, there's some of these great stories that end up back in the Northwest Territories where you have to fly in everything. I mean, I don't buy those. because it's too expensive. They even have to fly in the employees. So, you need to know the issue in terms of where this is located in maybe a good country, but if it's off in the middle of nowhere, that's all cost related, and you end up with a lot of issues there. Oh, let's see. Oh, labor availability. One of the reasons why, if I'm going to buy an Explorer, and I have owned some, but what I like is one where they're exploring to create a new mine in an area where there are already mining companies operating. So there's several advantages to that. One is you frequently find more gold where people have already found gold. The other thing is there's a potential acquiree there. And if it's close enough to that big company whose deposit is dwindling, and they buy your new company, they don't have to build a new processing facility. They just transport it over to the existing one. So they're a lot more likely to buy your company because it's worth a lot more to them than anybody else. So I find those very interesting. So I have one in Alaska and two in Nevada that are the one explorations that I like because the company is good and it's located right close to other gold producers. So I figure they're not going to have a problem in terms of finding somebody who wants to buy it if they don't develop it. And most of the time, that's what happens with explorers, because exploring has one kind of expertise and mining is a different one. And so exploration stories that tell you, yeah, well, if nobody buys it, we'll put it into production. Because you got to have a whole new set of people, the mining engineers who know how to build mines and get them into production. Very different skill set. And it's rare that an exploration company actually has both in their management, particularly because if you're just doing exploring, you don't want to pay somebody, a mining engineer, to build a mine when you're not going to build a mine for a couple of years. So that comes later. But again, then there's a shortage of those people. So the management of the exploration company can tell you, oh, yeah, well, no problem. We can get that. They're not out there. They all got laid off in the previous 10 years. So anyway, those are just some of the issues that are existing when you invest in explorers.
Those are really good to bring up. And I think some of them are definitely things that investors might not typically think of. So really good to go over. I wonder if we can talk more about how all of this research that you're doing is impacting your investing strategy. So how are you preparing as we head into hopefully this bull run?
Well, for myself, as I've indicated, I'm tending to have fewer explorers and developers, to be more selective, and I would advise investors who don't have a lot of time or accounting or engineering expertise to not get into the explorer developers too much, because it takes a lot of research if you're going to avoid the bad ones, and there's a lot of not so good ones out there. There's very few explorers who actually end up becoming successful mining companies. Not very many. So you need to have some, I say, both the time and some skills in order to feel like you can make those choices and separate the wheat from the chaff, so to speak. It's not that easy, as I mentioned, the list of things there. So there's that. The other thing that I've been doing recently is to shift more into silver, because I believe that, as you noted earlier when we talked about the change in the gold price, that the silver price was always also double, either on the upside or the downside, right? Well, the silver's been in the doldrums for quite some time, but it is now starting to move. And when it moves, it tends to move more than gold, just like what we saw. And so I think the gold and silver ratio tells me that at 80, which is high, that it's going to come down. Over the last 50 or 60 years, the gold-silver ratio has varied between 40 and 100, and now it's about 80. In 2011, it was down to 33 for a short while. So it just shows you what happens in bull markets. It goes up and it goes down. And so I'm saying that if this is indeed a bull market that we're in, which I think we are, then silver's going to do better than gold. And that's what happened in the earlier decade when I was first investing, and I was almost totally in silver, and I made lots of money. So with it, I've decided to get back into that again, but I'm not going whole hog. I think the idea is for me about half and half, gold mining and silver mining, because if we have a serious recession and the economy tanks and it tanks badly, silver will do badly because it's both an industrial metal and a monetary metal, but it's significantly industrial, and so it's going to be impacted very poorly. So gold will do better or less bad than silver if we have that downturn. And if we get back into inflationary mode, then silver will do better than gold. But gold will do well either way, because it does only poorly when everything's fine. If things are going sideways, up and down, around, then people seek the safety of gold. So I would always want to hold and retain gold, and the gold bullion I own, I will never sell. I want my children and grandchildren to have that. And whereas silver, I would trade. Does that give you an idea of what I'm thinking?
Yeah, it does give me a pretty good idea, I think, of what you're doing right now. We've gone through a lot of concepts here today, but I want to ask if there's anything that we missed, because you're out there doing so much research, paying attention to a lot of things. Are there any other points that you would want investors to know about in terms of what you've been looking at?
No, I think we've covered most everything. I think the thing I would encourage people to do is to do some of the kinds of calculations that I'm discussing for themselves, so that it helps them to get an idea. It's always useful to quantify things, and so that you're not going by emotion or making guesses. And so, if anything, what I've done is not rocket science, and people can do that. The information's readily available. Go to the websites of all of the mining companies that you're interested in. They all have now good websites. When I started this 20 years ago, it didn't have that. There was no uniform practice of giving all-in sustaining costs. That's relatively new over the last 12 years or so. So that is very helpful. So you could calculate gross margins and all those things. And there's just a lot of good information on the websites. In fact, one of the ways I tend to grade a company is if the website's good. If it's poorly done, if it's hard to understand, if there's mistakes, then, and I, of course, being a numbers guy, I look at all those things and say, wait a minute, page 1 said one thing and page 10 said something else, and so your IR people are not paying attention. That's not a good sign. But so anyway, the websites are easy to read, and I encourage people to take advantage of that, because there really is a lot of information available to the ordinary investor like me, and most of the folks out there.
I think this is a great message to end on. I like the point that you can do this. It's not rocket science, as you said. People can go out there, do the calculations, make their own conclusions. I think that's a really good point for us to close on. So thank you so much for coming by to speak again about what you're seeing with the gold and silver stocks. I will encourage everyone who wants to know more about your calculations to go back and watch that first interview, which I'll leave the link again in the video description. But thank you so much, Don. I think it was great to go over these things with you.
Wonderful. Thank you. I really enjoyed it.
That's great. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Don Hansen.